Hello students, this is Professor Alexander Buckholz here. Wanted to go over with you today our next section of the course, which talks about managerial accounting. And what I'd like to actually do for this particular chapter, which is chapter 14 by the way, is kind of walk you through the slides so that you can see what it's all about. So if you haven't done so, go to our Wiley site and download the lecture notes. So our first couple slides really talk about our objectives, which talk about the distinguishing features of managerial accounting, the three broad functions of management, the three classes of manufacturing costs, and distinguishing between a product and period cost. And our final objective, explain the differences between a merchandising and manufacturing income statement. We then also have indicating how cost of goods manufactured is determined, explaining the difference between a merchandising and manufacturing balance sheet, and trends in managerial accounting. So if we go to slide 6, management accounting is a field of accounting that provides economic and financial information for managers and other internal users. Since our course is business decisions, accounting for business decisions, management accounting must play a very pivotal role here, because what we're going to be doing is now going a little bit askew from our debits and credits that we've been doing in the early part of the course, and going into management accounting, which talks about providing these debits and credits, these balance sheets, income statements, statements of cash flows, and now giving them to managers to make an ultimate decision. Now, if we go to slide 7, management accounting, managerial accounting, we're going to use those words interchangeably. It applies to all types of businesses: service, merchandising, and manufacturing. Service being if we were doing consulting activities. Merchandising, where we perhaps sell, let's say chairs, we sell chairs. Manufacturing is where we actually produce and then sell those chairs. So the difference between a merchandising and manufacturing is we're not producing the actual inventory or product. In manufacturing, we do. This applies to all forms of business organizations: proprietorships, partnerships, and corporations. And this can be done for both for-profit as well as not-for-profit companies. If you're a not-for-profit nursing home, you still need to know how to make a decision, just like a for-profit Microsoft would have to. Again, managerial accounting basics, some distinguishing features continued. We're changing the role in collecting and reporting costs to management as a result of increasingly an automated business environment. Okay. We've also got, there are now more responsible for strategic cost management, assisting in evaluating how well resources are employed by the company. We have resources that we're using. Managerial accounting says, well, are we using those resources wisely, logically? Are we spending too much? Are we spending too little? Accountants are now serving on teams with people from different areas. If you're an accountant today, and if you're a managerial accountant, you need to be making decisions. Well, when you get to that stage of a controller, maybe director of finance, as some of you are, you know that you're not just dealing with people in the finance office. You're dealing with people in administration, marketing, engineering, and you've got to all come together and come up with decisions to really make the best one, or I'll call it the better one, for your organization. Because we're going to be making strategic, critical decisions. Should we be producing something? Should we not be producing something? Should we purchase a piece of equipment? Should we lease it? Should we enter into a joint venture with a company? Should we not? If we go to slide 9, and if we compare managerial and financial accounting, Again, I'm just going to go through overall kind of similarities and difference. How are they really similar? Obviously, we need the debits and credits that we did in our earlier chapters in order to make a proper decision of what to do. That's really the similarities. In terms of our differences, financial accounting is going to the outside user. The outside user gets that balance sheet, income statement, statement of cash flows, and other comprehensive income. And they use it to make decisions about whether we should invest in this company or not invest. Managerial accounting is more focused on the internal users. The internal users. So it might be producing data. We here at the School of Professional Studies in CUNY, we get data all the time. And that data does not go to the public. It may go to our individual academic leaders to decide, should we be offering this program? Should we be offering that program? Is enrollment good for one course? Is enrollment good for another course? So we're focusing more on the internal user. And that's kind of what's covered on slides 9 and 10. And then, of course, we have a little review question here on chapter 11. And managerial accounting, we've got our 4 choices, and we see that managerial accounting, our best choice is choice B. That places an emphasis on special purpose information. Okay, we're then going to jump ahead in terms of our slides. Slide 12 then goes to the management functions. We can really categorize it in 3 levels: planning, directing, and controlling. When we talk about planning, we're looking to really establish objectives, maximize our short-term profits and our market share. We want to add value to the business. Now, value can be defined very, broad-based. Traditionally, if we are a publicly traded company, though, I think value would be defined as measuring the trading price of a stock. It's a very easy measurement to really come up with and quantify. In terms of directing our activities. We're coordinating the diverse activities and human resources. Many of you have put on your welcome boards the type of roles you play in your companies. And you're not just dealing with numbers, you're dealing with people. You're dealing with what's called a human resource aspect. We then want to implement planned objectives, provide incentives to motivate employees. We all know from our management courses that if our employees are not happy, if our employees are not satisfied, they're not going to give us 100%. They're going to give us less than 100%. And that then is going to delay productivity, efficiencies, and effectiveness. And we don't want that. Management functions involve hiring and training employees on all levels. Executives, managers, and supervisors. You could be the best manager there is, but if it's just you and 100 employees beneath you, how effective are you really? You need that secondary level. And of course, you want to have a smooth running operation. The last thing we said was controlling. Process of keeping activities on track. Are the goals being met? And what changes could be needed to get back on track? And our slide here points this out very nicely. Decision making is not a separate management function, but the outcome of the exercise of good judgment in planning, directing, and controlling. I think that's a very important phrase here, and it just goes to show how important managerial accounting really is as a whole. Slide 16 gives a general overview here of an organizational structure. I don't think we can use this across the board for all companies, but I think we can use it as a skeleton to get you a little more comfortable. At the top, and again, please note that on this slide 16, we're talking about a publicly traded company. A publicly traded company. And in this publicly traded company, we've got stockholders. The stockholders are then voting on a board of directors. Those board of directors will then appoint our executive management team. Typically our chief executive officer, who's our CEO and president. And then that person will choose his or her own team. For example, the far left we have our general counsel, typically our lawyer, vice president of marketing, the vice president of finance, or more commonly known as the chief financial officer. And you'll notice that under the chief financial officer, we have the titles of treasurer, usually somebody who deals specifically with cash and cash management, and then the controller who may manage the general ledger functions, making sure things are being posted, things are being recorded properly. Next to our vice president of finance, we have our vice president of operations, somebody who makes sure that the day-to-day activities are running as they should be. And finally, our vice president of human resources. Some companies may mix these things together. Your company may do it differently. Again, our textbook is just trying to give you a nice overview of what's out there. Obviously, our next couple of slides really talk about the concept of ethics. Ethics are very important. We see there's a lot of scandals going on today, a lot of people being blamed for things. So ethics, and that's something that we cannot teach you. I don't think any university could teach you. It really is something that we can talk about at a very high level, saying, do we need to have ethics? And the answer is yes, we do. We can argue that there are such a thing as professional ethics versus individual ethics. You may be a very different person by yourself, but when you get to work, you realize, wait a minute, I've got to be serving another master. I'm serving my company. And I need to make sure my company does well. Because if they don't do well, I don't do well. So your ethics may be very, very different. Again, there are various things that companies do to promote good ethics. Hotlines are a big thing. That, the company's got a hotline, you call them up. And if there's something you don't like, you report it. That's one thing that's out there. The other items which are out there as well is what a lot of companies have done now is there's corporate officers for this. There are hotlines, whistleblower protection. The Sarbanes-Oxley Act of 2002 spoke about creation of a code of ethical standards, and that actually needs to be certified by the CEO and CFO. So if we jump on over to slide 20, we have another little question here. The management of an organization performs several broad functions, and they are, well, if we take a look, our answer is D as in David, the planning, the directing, and the controlling. All right, now we get to slide 21. So now we're going to kind of get back into our accounting. Here, we've kind of been giving you a nice HR overview, but now we want to get into how does this apply to us? And we talk about manufacturing costs. Well, manufacturing costs talk about, and they consist of activities and processes to convert raw materials into finished goods. So we're talking about now, when we talk managerial accounting, we sometimes are leaning towards companies that are manufacturing. Again, we're a company, we're going to produce those chairs, and those chairs are then going to be sold to somebody. We've got to produce them. So when we talk managerial accounting, we need to talk about manufacturing costs. And typically, manufacturing costs are broken down into three categories, really: direct materials, direct labor, and manufacturing overhead. We're going to define those over the next couple of slides. So I need you to go to slide 22, raw materials, or rather direct materials. These are the materials that we're going to be using to produce a product. If we're going to produce chairs, we're going to need, the wood, we're going to need fabric for those chairs. Those are direct materials being used to create our product. They are directly associated with them. Well, if there's something that's an indirect material, raw materials that cannot be easily associated with the finished product. Maybe it's not a physically part of the finished product, or it's such an insignificant part of the finished product in terms of cost, that we don't consider it to be part of the direct materials. We consider it manufacturing overhead. So maybe in our example of chairs, maybe the glue might be something that we're not sure of specifically how much of it will go to the chair. It's going to be an indirect cost, but it does vary. The next manufacturing cost we spoke of was direct labor. These would be people working on our chairs, the people on the production line, the people who are there literally putting together the product. Indirect labor would be the work of the factory employees that have no physical association with the product. Maybe our factory supervision. That might be somebody who, yes, he's involved, but he's really indirectly related. We can't trace the foreman to the specific product. We can trace him that he's in the factory. We can trace what he's doing, but he's not directly assignable. That would be indirect labor. Manufacturing overhead talks about costs that are indirectly associated with the manufacturing of the finished product. And it's kind of a catch-all. Notice what our slide does. It says, if you're not direct materials, you're not direct labor, you're a manufacturing cost. So they kind of, do as a catch-all. But again, it's got to be associated with the product itself. We're going to see what happens when there are other costs involved, how that, is treated. So again, that was slide on the direct labor, on the direct materials, on the overhead. And again, on slide 26, we give us a nice question. Which of the following is not an element of manufacturing overhead? The plant manager's salary, the repairman, the product inspector's salary. Those three, are they involved with the product? Absolutely. Can we directly assign them? No. That sales manager, well, you may say, well, Professor Buckles, he does do something with the product, but he's selling it. He's not directly involved with the creation. So we really can't use him as part of the overhead costs. We then go on to the next couple of components that talk about what is a product cost versus a period cost. Well, product cost basically is direct materials that we just saw, direct labor that we just saw, and manufacturing overhead. Manufacturing, they are necessary and integral. These product costs are eventually, once this chair is assembled, it's going to become inventory. And you might recall from our earlier chapters that inventory is an asset that goes on the balance sheet. So that means this is going to become a capitalized item. It's going to be inventory. And when we eventually sell this particular product, when we sell this product, it's going to turn into a period cost at a certain point. What's going to eventually end up happening is, well, we're going to eventually sell this product, and when we sell the product, of course, we will debit our accounts receivable, credit our sales revenue, we will debit cost of goods sold, and credit the inventory. A period cost obviously is matched with revenue of a specific time period and charged to expenses incurred. You may want to make a note for yourself. That was that whole debiting cost of goods sold and crediting inventory. Non-manufacturing costs. And basically what happens is we also deduct from revenues in the period incurred to determine net income. And it also includes our selling and administrative expenses. That manager who's a salesman is a period cost. The salaries of the accounting personnel would be an administrative cost because we're not associated with that. I want you to jump over to slide 30. Then talks about manufacturing costs in financial statements. The income statement is very similar to a merchandising company, except for the cost of goods sold section. See, in slide 31, when we talk about a merchandiser, cost of goods sold, which you know goes right after revenues, we have the beginning merchandise, we have the cost of goods purchased, less our ending inventory gives you the cost of goods sold. But in the manufacturing, it's beginning finished goods inventory. It's beginning finished goods inventory. And let's just take a moment to kind of talk about this concept of finished goods. When you're in a manufacturing sector, we have direct materials. Well, those direct materials get broken down even more into the raw materials that you first purchase. We're going to buy wood for these chairs. That wood is then going to turn into another asset called work in progress, WIP for short. And that's part of the product cost. We're then going to go, and once it's done that chair, it's going to become a finished good. So in the manufacturing sector's cost of goods sold statement, you're going to have the beginning finished goods plus the cost of goods manufactured less ending finished goods. If we then go down to slide 32, it actually just shows you some numbers here, gives you some illustrations. We then go to slide 33, which actually gives us a nice example here. For the year, we company has cost of goods manufactured of $600,000, beginning balance of finished goods inventory of $200,000, and ending balance of finished goods of $250,000. The cost of goods sold is, well, again, our beginning inventory of finished goods is $200,000. We then add the cost of goods manufactured is $600,000 less those finished goods gives you $550,000. $550,000. Okay. The next one. Okay, when we talk about slide 34, we're talking about determining the cost of goods manufactured. Unfortunately, for a manufacturing sector, it is a little bit different. What happens here is, we said that the work in progress account, or work in process account, is partially completed units. So what happens is, computing the cost of goods manufactured, we have another subsection. We start with the beginning work in process inventory plus total manufacturing costs gives you a total cost of work in process. Less the ending work in process inventory gives you the cost of goods manufactured. The total manufacturing costs basically give you The total manufacturing cost is the sum of direct material costs, direct labor costs, and manufacturing overhead, all included in the current period. So again, total manufacturing costs are your direct materials, your direct labor, your manufacturing overhead. You use that plus beginning work in process, less the ending work in process, gives you cost of goods manufactured. And slide 35 shows us a nice example of how we get the cost of goods manufactured. We then go to slide 36, and we compare. So on a balance sheet for merchandising companies, we would see the typical merchandise inventory. And we've seen that before. In a manufacturing, we may have 3 individual accounts. We may have inventory, and then right underneath that have a subsection for raw materials, work in process, and finished goods, as shown on slide 37. Slide 38 then gives us a nice review question. A cost of goods manufactured schedule shows beginning and ending inventories for raw materials and work in process only. Raw materials and work in process only. The last part of this chapter talks about managerial accounting today. It talks about what's going on in the economy, what the trends are. So I'd like to jump to slide 40, which talks about the value chain. And value chain refers to all the activities associated with providing a product or service. Well, research and development basically is part of that. Acquiring raw materials, producing them, selling them, delivering them, and good customer relations. All of these things filter into the managerial accounting practices of today. If we don't have good customer relations and we start to lose business, well, obviously that means our revenue sooner or later is going to go down, and we're not looking for that. We also have a lot of technology changes. ERP, some of you may have heard of that, Enterprise Resource Plan. Using one system to control several systems. We find that to be more effective and more efficient. Computer integrated manufacturing. Again, using automation to produce things. Just-in-time inventory methods. Inventory system, in other words, we want to manufacture goods just in time to meet a deliverable. We don't want to have excess inventory on hand. Let's think about this. If I have excess inventory on hand, I need to manufacture, or rather I need a warehouse to store them. Maybe we don't want to incur that overhead, that rent, that electricity. We'd rather have just in time to meet our deliverables, and then from there be more effective and efficient. Quality, total quality management. We want to have 0 defects. Well, I think it's a nice goal, but I think in today's world, you're always going to have some sort of defect, some sort of spoilage. It's just not feasible to have 100% efficiency. Activity-based costing, again, allocates overhead based on the use of activities. And it results in more accurate product costing and scrutiny of all activities in the value chain. On slide 43, we talk about the theory of constraints. Constraints limit the company's potential profitability. A specific approach to identify and manage these constraints in order to achieve company goals. What could be a constraint? Again, we're dealing with personnel, we're dealing with budgets, we're dealing with salary limitations, we're dealing with human resource considerations. If we have to get a product done, and let's assume that it involves overtime, well, maybe that's something we don't want to give out. Overtime, again, time and a half, costs us too much money, may not be worth it. That's a constraint. And on slide 44, We have a nice review question. Which of the following managerial accounting techniques attempts to allocate manufacturing overhead in a way that leads to more accurate product costs? And our answer there is D, activity-based costing. We then have on slide 45 and 46, read exercise 14.5. And what it wants us to do is indicate whether each of the following costs of an automobile manufacturer would be direct materials, direct labor, or overhead. Now let's take a moment, let's go through that. The windshield, well, if it's an automobile, DM, direct material. An engine, direct material. The wages of an assembly line worker, well, he's on that line, he's doing the work. That's direct labor. Depreciation of factory machinery, that's overhead. Why is that overhead? Because we don't know which machine is going to which specific product of the automobile, or which specific automobile. We need to depreciate it as a whole. Factory machinery lubricants. Again, it's lubricating machinery in the entire place. That's manufacturing overhead. Tires. I don't know about you, but I want my car to have tires. That's a direct material. Same thing with that steering wheel. That steering wheel needs to be a direct material. Salary of the painting supervisor is manufacturing overhead. Again, this particular person is going to several different automobiles. It's not going to be directly identifiable. So we're going to put him as overhead. And just as a side note, manufacturing overhead is subdivided into two things. Variable overhead, which means it varies, and fixed overhead, meaning that it's fixed. How do we allocate overhead? Overhead needs to be allocated. And that's a little bit above the scope of our course. The chapters in our textbook do discuss it, but to go into in-depth analysis, that would really be something more if you were doing an accounting master's or had more of an interest. Again, if you have questions on specific allocations, please email me, over the course of the semester, and I'd be more than happy to discuss that with you offline. Now, on slide 46, they continue the concept of, all right, which of these costs are product, which of these costs are period. Manufacturing overhead is a product cost. Selling expenses, SG&A, so to speak, sales, general, administrative, is a period. So that's selling. Part C, administrative, would be period. And there's Part D, advertising, period. Direct labor is a product cost. And direct material is a product cost. And that really concludes our chapter. Again, this chapter is meant to serve as an introduction to what manufacturing costs are, what managerial accounting is all about, and what we'll be discussing for the next couple of sessions. Okay, if there are any questions, please email me using the discussion board in Blackboard, and we will see you online. Thank you.